Good afternoon. It is Sunday afternoon, August 11th. My name is Joe Terril. I'm president of Terril and Company, independent wealth managers in St. Louis, Missouri, with approximately $625 million of discretionary funds under advisement. And we will be updating our thoughts on the economy and interest rates, equity markets. As always, helping me with the videos is Jesse Baker. Jesse, how's your summer going?
It's going hot.
It has been a little warm a few days this summer. But with that said, Jesse, it's going to be probably the shortest video we've done in quite some time, because there hasn't been a lot change since the last video that we recorded. So with that said, you want to do it here? You want to go in the conference room? Where you want to go from here, Jesse?
Wherever you think is good.
Okay. As I stated, the summer has been pretty slow for the investments. The economy is showing past growth during the year of the 1.5% range, maybe nominal growth being closer to 3%, but we believe at Terril and Company this is going to be higher by the end of the year. The economy is making improvements in several areas that lead us to believe there's going to be more corporate spending. There will be more activity on that side of the economy, which should lead us to closer to 2.5–3% growth by the end of the year, which maybe will be 4.5% nominal GDP growth. Part of this is there's a very basic saying about the economy that 2/3 of the economy is the consumer, 1/3 of the economy is business. It's the 1/3 of the economy that is business that we think is going to do better, while seeing the consumer continue to do okay as purchasing, etc. Now, this is not to say that the economy is great, that there aren't people unemployed, that there aren't people that have even dropped out of the marketplace and looking for a job. It's simply a statement that those people that are working have the best consumer balance sheets they've had in a long time, and they continue to buy cars, they continue to refinance houses, buy some new homes. So we look for the energy sector of the economy to continue to be strong, auto strong, housing strong. If we can get a pickup from business spending, we should see, and this is what we believe is going to happen, we should see the economy do better and maybe growth pick up as we get farther into the end of the year. The last time we recorded one of these videos, the 10-year government bond was 2.2%. We made the statement that we think it'll be 3% by the end of the year. Well, here it is right now at 2.60. And we continue to believe that's going to happen, that interest rates are slowly going to go higher. As interest rates go higher, bond prices will be a bad place to invest. We're saying it over and over again. I get asked by people, do I think the stock market's going to crash? And my standard answer is no, I really don't. Stocks are moderately priced, but the bond market is going to crash. But it's going to be more of a slow crash as people month by month see the value of their bond mutual funds and bond holdings go down in value as interest rates slowly go higher. So we have seen no real changes in the Fed's posture. The Fed is playing it pretty flexible, stating that they're going to try and begin to slow down, or if you will, taper their purchases of monthly treasury bonds or injections of liquidity into the economy, which, as we've also stated again and again, is not necessary. Somewhere down the road is going to cause more problems than good. So as the Fed does that, as the economy gets stronger, we look for the markets to maybe react to it, but in general that's good news, not bad news. So just trying to sum it up, we continue to remain mildly positive on stocks. Stocks are not overvalued. I see nothing that leads me to believe at 15 times earnings that the stock market's going to crash or anything of that nature. The reason I'm not a little more optimistic on equities is just that. Stocks are at 15 times earnings. Back the clock up 2 or 3 years ago when they were at 10 times earnings, you could make the case for some nice upside in stocks. Sort of hard to do it right now. Corporate profits, I'll be real interested to see if the growth in corporate profits can keep up during the third quarter and the fourth quarter of the year. I tend to think it will, and that's part of our mildly positive outlook for equities. So, Jesse, with that said, not a lot that's changed this summer. We look for higher interest rates. We look for the economy to be decent. Look for stocks to be okay. Very negative on bonds. Mildly beginning to change our mind on commodities. We've been negative on commodity and commodity prices the last 2 to 3 years. We'll see. They've had a nice drop in price and a pullback, which begins to make them look a little more attractive. But we'll see as the next few months go on what begins to happen with inflation, which ultimately will become the big problem with investment markets. But it's not there yet, so we stay with our mildly bullish position towards equities. U.S. dollar should continue to stay strong, and we are still buyers of floating rate bonds to protect ourselves against increases in prices. We actually should get some principal gains out of them, as some of these floating rate issues are trading at a discount to face value. So with that said, Jesse, let's wrap it up. Thank you for joining us. I'm Joe Terril, president of Terril & Company in St. Louis, Missouri, and we will be back in 30-45 days with an update on our thoughts on both the economy and investment markets.